Hi everyone. We are going to be looking at Chapter 9 here. Now Chapter 9, you can see that it says accounting for receivables. Not all of that is new, right? We've been dealing with receivables since way back in Chapter 1 and 2. So this part's not new. The beginning, we're going to just review over accounts receivable, talk about other receivables, and then we'll get into the new parts. We are going to look at how do we handle when someone doesn't pay us, because we talked a long time ago that we're assuming that everyone's paying us, but we know in reality that doesn't always happen. So in this chapter, we're going to get into looking at how do we know when to write it off? How do we know when it's not going to be received? And what does the accounting for that look like? So as we get into looking at accounts receivable, again, as I said before, the beginning part's not new. We know that a receivable is something that someone owes us. It's when someone owes us money, whether it's accounts receivable or a note receivable. Remember the difference between accounts receivable and a note receivable? Typically is that a note receivable means that they are going to be paying interest on top of that balance. So this slide here shows us the dollar amounts of receivables and the percent of total assets of 4 pretty big companies: John Deere, Callaway Golf, Pfizer, and Abercrombie & Fitch. So we're looking at this. Remember that accounts receivable comes from credit sales. When we're selling to someone on credit, they're not paying us cash right now. They're going to pay us sometime in the future depending on the terms we've set up for them. So we typically have some kind of a control account, accounts receivable, that we're logging in all of them. And then we're going to have some kind of a supplementary record that's going to show each customer. And that's where we're going to be looking at something called an accounts receivable ledger, or also known as accounts receivable subsidiary ledger. All right, so going back again, beginning part is review. We're looking at sales on credit. So this one says July 1st, TechCom had a credit sale of $950 to CompStore and a collection of $720 from RDA Electronics from a prior credit sale. So we're selling on account, we're debiting that accounts receivable, increasing accounts receivable that we're going to receive sometime in the future, and we're crediting sales to record the credit sales that we have for that period. When it's time to collect, we're going to be debiting cash because we're receiving cash, and we're going to credit accounts receivable to reduce the amount that's shown on their account as what they owe. When we look at that a little further, again, like I said, we're going to have an accounts receivable ledger that's going to be broken down for each customer. So we have accounts receivable that we're debiting and crediting in these accounts, but we want to keep track, and you can see here that there's one for CompStore and one for RDA Electronics, because we need to know which customers owe us for which accounts. So we can see here that we have the general ledger, which is accounts receivable, and it's broken down into a schedule of accounts receivable, which lists each customer what they owe us. The total matches what's in that general ledger. And then we can keep track of each of the clients by looking in that accounts receivable ledger and tracking what they pay and when they pay it. Something we haven't talked a lot about yet is when we have stores or we have sales on a store credit card. So this is when it's a credit card that we own. So it's our own store card. So this example, it says November 1st, TechCom recorded sales on their own credit card in the amount of $1,000. So here we're debiting accounts receivable because they're repaying us. It's our credit card, they're repaying us. And we're going to be crediting sales. The other one, December 31st, is they recorded an adjusting entry for the interest earned at the rate of 1.5% per month on the seller credit card. So remember, if they're paying on a credit card, they're going to owe us interest for that time period. So we have from November 1st to December 31st, they're paying interest. So we have 1.5% that's owed on that balance. So 1,000 times 1.5% comes out to $15. So we're going to increase what they owe us by debiting accounts receivable, and we're going to credit interest revenue because it's not additional sales, it's interest that we're earning. So we want to make sure that we differentiate those. The other thing we can have is we might accept customers' payment in the form of Visa, MasterCard, American Express, or even a debit card. And those are considered sales on a bank credit card. So here it's giving us the example of TechCom. But what we have to remember is that we're allowing those customers to use those credit cards, and what we have to think about is the seller is avoiding that risk of the customer not paying, right? Because it's the credit card company that's going to pay us. So that risk is transferred to the card company. Then the other thing that we have to think about is that we're receiving cash from that card company sooner than we would if we had granted credit to those customers. So it's better for us to accept those different credit cards because we're going to get payment sooner. Having those different credit options is going to open up more sales. So the example they have here is TechCom has $100 of credit card sales and it has a 4% fee. And that means that we have $96 being received immediately. So the entry is a credit to sales for the total amount of $100. Remember, TechCom is going to get cash of $96. That's how much cash we're going to collect from the bank. The difference of $4 is the 4% fee that TechCom has to pay for allowing customers to use that third-party credit card like Visa, MasterCard, American Express, Discover. That $4 is going to be debited for us as a credit card expense. So we're not getting that cash. The credit card company is only going to pay us $96. So we have an expense of the additional $4. So that's the downfall. And that's why a lot of times you'll see that companies will say there's a minimum purchase because they have to pay that fee. So a lot of times they want to cover the fee that they have to pay. The next kind we're going to look at is sales on installment. So this is where we can allow our creditors to make payments over several months. So, for example, Harley-Davidson has more than $2 billion in installment receivables because they're financing their customers themselves. So it's amounts that are owed by customers from credit sales, which are requiring periodic payments. Typically, the installment receivables require interest payments, and they can be either current or non-current assets depending on the time of repayment. So a sales on installment is where you're financing your own customers and you're getting interest from that. All right, so next we're going to look at what happens when someone doesn't pay you. So we know that some customers are not going to pay on their account. So those uncollectible amounts are referred to as bad debts. There are two methods of writing off bad debts, or two methods of handling bad debts. There's the direct write-off method and then the allowance method. So why do companies sell on credit if they expect some to be uncollectible? The reason is because we believe that granting credit is going to increase our total sales and our net income enough to offset those bad debts. So again, we're going to look at two methods, the direct write-off method and then the allowance method. So direct write-off method is going to be recording the receivable we're going to be writing off the receivable when it's determined to be uncollectible. We're not attempting to predict what that bad debt expense is going to be. So the example here, it shows TechCom determines on January 23rd that it could not collect $520 owed to it by its customer, J. Kent. So they've determined January 23rd that J. Kent isn't going to pay them. The reasons why you might determine that might be a period of time. It might be based off of history with that customer. It might be based off of the credit terms you've set up and how long it's expired since then. But here, with a direct write-off method, that's what we're doing, is we're writing it off directly. So we're debiting bad debt expense for that write-off, and we're removing it from accounts receivable so that it doesn't show that they owe us that anymore. And we're not reporting that as a receivable on the balance sheet because that increases our assets. And if we don't really expect to collect it, then that would be inflating our assets, which we don't want to do. Now, the one thing to remember, this is writing it off. That doesn't mean that J. Kent may never pay it. So sometimes they may decide, even after you've written it off, they're going to pay it. So in that case, they're giving the example here that, we wrote it off on February 23rd. But then on March 11th, J. Kent decided that they could pay all of it. So they're paying a full amount of something that was previously written off. So we have two steps. First, we have to put it back on the books because remember, we removed it from accounts receivable. So we can't just collect on it. We have to put it back into accounts receivable, reverse that write-off entry by crediting bad debt expense, and then we can collect it by debiting cash and crediting accounts receivable. So here's the thing with the direct write-off method. we have accounting principles we have to follow that the direct write-off method doesn't follow. So it's usually not the best method because it doesn't match those sales and expenses. Remember, going back to that expense recognition principle where it requires expenses to be reported in the same accounting period as the sale that produced those expenses. So we have to make sure that we are following that expense recognition principle, and the direct write-off method does not do that. So the other method is called the allowance method, and that's what we're going to be looking at. All right, so let's look at the allowance method. So at the end of the period, we're going to be estimating the total bad debts that we expect to be realized from that period's sales. So if we had $100,000 of sales and we estimate that 1% is going to be uncollectible, we're going to estimate that 1% and we're going to do a journal entry to record that. So there's two reasons we do that. Number one, it's going to record the estimated bad debt expense in the period when the sales are recorded. And it's also going to report accounts receivable on the balance sheet at the estimated amount of cash that we're actually going to be expecting to actually collect from our customers so that we're not overstating those assets. All right, so the example they give here, it says that TechCom has credit sales of $300,000 during its first year of operations. At the end of the first year, $20,000 of credit sales remains uncollected. Based on the experience of similar businesses, TechCom estimated that $1,500 of that $20,000 would be uncollectible. So what they're doing is they're debiting bad debt expense, and we're creating this new account called Allowance for Doubtful Accounts. Allowance for Doubtful Accounts is a contra asset account. So remember, it has the opposite balance as a normal asset. So a contra account is used instead of reducing accounts receivable directly because at the time of the adjusting entry, we don't know which customers are not going to pay. After the bad debts adjusting entry is posted, then TechCom's account balances for accounts receivable and its allowance for doubtful accounts are shown here at the bottom. So we can see that accounts receivable is $20,000. We have an allowance for doubtful accounts of $1,500. So if we look at what do we actually expect to collect, we can see on the next slide the balance sheet presentation looks like this. So we have accounts receivable of $20,000, but we expect to write off $1,500. So we actually expect accounts receivable net amount to be $18,500. So because of this, we're actually reporting what we think we're really going to collect instead. All right, so if we use the same example, J. Kent, $250 is going to be, I'm sorry, $520. That's a mistake in the PowerPoint. It should be $520. So I'm going to fix that. So it should be $520 is uncollectible. So in this example, again, it's the allowance method where we're estimating, right? So we're debiting allowance for doubtful accounts for a specific account, and then we're removing it. Remember, when we did the previous entry, let me go back to that slide, we estimated that $1,500 is going to be uncollectible by debiting bad debt expense and crediting the allowance account. Now that we have a specific customer that we're writing off, we're going to write it off against that estimate, that allowance for doubtful accounts. So we're going to be using allowance for doubtful accounts as the debit and then crediting the account that we're writing off specifically. So we can see here that the write-off doesn't affect that net realizable value of accounts receivable. Remember, it was $18,500 before the write-off, and if we look at the changes after that write-off for J. Kent, we can see that accounts receivable went down by $520, but so did the allowance for doubtful accounts. So we still have the realizable value of $18,500. So we're still recognizing the amount that we actually should be collecting for that one. All right, just like before, if they decide that they're going to pay us, we're going to reverse that write-off entry. So we're going to debit accounts receivable, put it back on the books, credit allowance for doubtful accounts, then we can debit the cash and credit the accounts receivable, just like we did in the previous entry. All right, that's where we're going to stop for this video. In the next one, we're going to continue on with looking at estimated uncollectibles based on sales and accounts receivable, so using another method.